on this? Oh, okay, see?
Is that better?
Folks at the National Association
Oh, you are there, I'm sorry. Yeah, sorry, my name. So it's. Okay, and then I'll go, and then I'll leave it down, and then I'll take it down. The podium, not the presentation. If you go over here, if you go over there. Sorry. So if, let's just say.
Agenda tonight.
Thank you.
Karen got me fired up.
I'm gonna zoom in right on you, get really close.
No, no.
So can, do we want me to zoom in or just leave it? Okay.
So is this your shift? Is the,
I'm sorry?
you're on this new shift?
Sorry.
Lieutenant Curry,
This
section
one here?
Jackson Five.
Yeah.
Oh, there you go.
One of his sergeants on the ship.
Oh my gosh, I could have too much fun with that. Okay.
Okay, thanks.
I just
He's
wanted
actually
to
out
ask
of the
that.
office for about next month.
Oh, is he? Okay.
Yeah.
Thanks
So
for
he asked me
coming.
to fill in.
Yeah, it'll be pretty low key. We want it to be low key, actually.
That's the hopes, right?
Yeah. Don't put him on there so he doesn't have to see
Okay,
us.
so he has a presentation, and I'm going to follow that. How I do that part is this, but then I'll do my first report after.
I'll just move him up front.
Okay.
And that way he doesn't have to sit here. And I'm moving to the president's remarks.
Okay.
Oh.
You'll be going after.
Okay.
You'll be going.
I'm trying to remember what.
Wow, is this, I feel about getting my blood and then bore him to death.
Well,
And then.
It's a whole, yeah.
Okay, yeah, I'm available either way, I said yes.
Basically, our budget, our surplus is swelling, and we've got all this
I
money.
think we've moved
It's
it.
like a sugar high, like, whoa.
Yeah.
Yeah, I mean, it's
I'll let you in it. Call
Okay, we are behind schedule, so give me just a second to get organized, ladies and gentlemen. If you would please.
Is the Zoom link open here?
Yeah. Yeah.
Sound check, 1, 2.
I wonder why I put this.
Are you gonna try song silence tonight? When they begin, slowly. Okay.
Yeah, we're gonna.
Yeah.
Yeah, there's no doubt about that. But that's fine.
These meetings will run with greater efficiency and dispatch when Andy's mayor, because he doesn't waste time with my hijinks. You guys will be more bored, but it'll be a lot more efficient. Is he on? I wanted him to hear that. We ready?
That one has things like that.
Okay.
Is there something we
You
have?
give me the cue.
Because we're actually looking.
Yeah, what kind of message was that?
Yeah.
Is there something that you're
That,
telling us? or what?
that he's smarter than me, but I'm more of a laughing stock. I'm more of a,
But other than that.
he's the good student, I'm the class clown.
It's hard to know, no, but I'll let you know. Yeah.
Okay, everybody should be able to hear us now.
Okay. Good evening, everyone. Chair would like to call to order the regular monthly meeting of the Board of Trustees of the Village of Lake Barrington. It is Wednesday, February 15, 2023, and it is 7:07 p.m. Central Standard Time. Clerk, will please call the roll.
President Richardson,
Here.
Trustee Burke. Trustee Burke.
Trustee Burke, are you present?
He's not on this one right now. Yeah.
Okay.
Trustee Hayes.
Present.
Trustee Perkins.
Present.
Trustee Schaller. He does not appear to be on. Okay, thank you. Trustee John Moser.
Present.
Trustee Van Ryn.
Chair will ask council to confirm for the record that a quorum exists.
It does.
Okay, would you all please rise and join me in the Pledge of Allegiance to our flag? I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Agenda item 4 this evening is approval of the minutes from our regular meeting last month, January 3, 2023. Are there edits, questions, comments for the clerk on the draft minutes? There being none, Chair would like a motion to approve the minutes as stated under agenda item 4A for the regular Board of Trustees meeting on January 3, 2023. May I have a motion?
So moved.
By Trustee Hayes, thank you. May I please have a second?
Second.
By Trustee Perkins, thank you both. Clerk will please call the roll.
Trustee Hayes?
Yes.
Trustee Perkins?
Yes.
Trustee Burke? Is he on yet?
He said he keeps getting dropped out. There's other people on the line now, so he's working on it.
Okay, Trustee Schaller?
He's not on
Not
the,
yet? Okay. Trustee Schallmoser?
Yes.
President Richardson?
Yes. Chair would like a unanimous consent that the record may open for a period of 5 business days for purposes of any necessary technical and conforming amendments without objection so ordered. Agenda item 5 tonight, President's remarks. We do have our presentation from Mark Bernardi from the Securities.
Bernardi Securities.
Thank you. And before you present, that way you don't have to sit here all night.
I appreciate it, thank you.
You know, my company's like Scotch whiskey. It's an acquired taste best done in small doses. So I'll eliminate that for you.
Thank you.
I will say that I was in the UK on business recently, and I spoke to the mayor of a very rather large community, and we were comparing notes, and municipal finance came up. Now, their structure of municipal financing is substantially, they have a council tax similar to our property tax.
Okay.
But I was thinking about this because I enjoy learning about how you make our money work for us. And I realized that he's got someone in his life like Mrs. Hirsch is in my life to keep me on the straight and narrow. You know, you're not on the audit side, you're on the investment side.
Yeah.
But I don't walk out of this building with a paperclip.
Yes.
So you've been working with the A-team. I dare say this is the best village treasurer you've ever worked with, so.
Don't put him to that test.
So
agree.
I have some other comments, but then on regular president, why don't you come forward and we'll let you present.
So Karen, my question for you is, he's going to present on his computer here. Can you hear him if he stands this far from the microphone?
yeah,
It's on.
Okay.
Is the red light on?
bottom.
Center in the bottom.
There you go. Okay. All right, you're up.
All right, great.
So we've been with Bernard Securities since 2015. So we've been with him for, I guess, 7 years now. This presentation is in your packet. Oh, no, where is it? But he's going to do it up on the screen, so it's a little easier for everyone to view.
But yeah, President Richardson, as you said, I would like to learn what you learned from how they do it in England, because in terms of their municipal finance, our municipal finance is based off of our federalist system of government with states' rights, the power of governors, the power of local government, and it's the original decentralization of finance.
Our founders had divinely inspired genius, in my view, and one of which was you don't want too much power taken away from the people.
Yep,
And when you do, you split it up so no one can bully you.
checks and balances.
Yeah, we have subsequently thrown most of that away over the last 70 years, but that's a red wine conversation outside Village Hall.
Well, that's why, crypto is very popular with certain people with certain political leaning, because the DeFi, the decentralization nature of it, munis are that.
Do you need help with the?
This was working, I swear to you,
sure.
before the meeting
I was
started.
here 20 minutes
Just
before
like
it
this
gets
one.
set up.
Sure.
I'm like, oh my gosh, it's not working.
Yeah.
Reverse and then.
Oh, it's emblematic that it's always going to fail when it's.
Or not, it might not be, yeah. Oh, yours is a different, mine, yeah, yours is a different. All right, we'll try it one more time. We might have to just go with what's in the pack, I apologize, but I saw it up working. And I'm the last techie person here, I'm not sure why I'm even looking over his shoulder. Oh, it's,
There we go.
there we go.
Wonderful.
Oh,
Almost.
The cord's very finicky, apparently.
All right, don't breathe.
Sound check for trustee Burke online. Andy, can you hear us?
Did we stand there and hold it?
He's saying no, he just responded, he can't hear.
It's something to do with the cord, it doesn't want to stay in the computer. Oh, sorry.
Okay,
it's going to bring them by soul.
it's gonna be treadway.
Okay. So anyway, you have the
Yeah,
second.
part of me wants to reprogram some of these funds. You tell me I can't spend twice.
Hey.
I want state-of-the-art technology that works every single time, whether it's this stuff she's doing or this.
Well, that's his own cord, he probably.
I think it's my cord.
Yeah,
It's awry, not because of my cord, but,
Don't touch it.
can I begin or?
Yeah.
Okay.
please.
So, yeah, thank you for having me. I'm Matt Bernardi from Bernardi Securities. We are municipal bond specialists, a high-grade fixed income specialist. I laid out an agenda here for you today. I'll talk a little bit about our firm, just an update, the portfolio, the market in general, and then a recommendation I have for changing the portfolio parameters. Before I get into that, I do kind of want to frame what happened last year, 2022, with fixed income markets. It was a historically horrific year. And that was because the Fed got on its back foot with fighting inflation and then attempted to fight inflation with very aggressive measures. And so this roiled markets. The bond market had a horrible year. It was one of the worst years in modern history. This portfolio, which has a very short maturity, was down on paper, had a negative value. The return is on paper. Every bond in the portfolio will mature at par. They will realize positive returns. But because of what the Fed did and where inflation was, it was a negative year for all bond portfolios and most asset classes generally. I do kind of want to give you an example of just a microcosm of what happened. In December 2021, we bought a bond for the portfolio. It was a 2-year Manhattan, Kansas bond, AA plus rated. So that's one notch below AAA. We bought that bond 2 years at 0.75%. The going 2-year treasury was around 0.5. The average municipal was 0.5 to 0.6. So the bond was safe from a credit perspective. That's where the Kansas State University is. And it was a higher yield than the alternatives out there. That's our main job, is to secure the principal and buy higher than average yields for the portfolio. That was a 2-year 0.75%. If we were to go sell that in the open market today, which we're not, we're going to let that go to maturity. It will mature at par, and your return will be 0.75% per year. But if we were to sell that in the open market today, the market would demand a rate of 5%. So we've gone from 0.75 to 5%. If we were to sell that at that price, that yield, it would lead to a price of about 99. That's a 2% loss from where you bought the bond. So that's just kind of one example. You consolidate that for the whole portfolio. The portfolio is down on paper, but these bonds will mature at par. That bond matures in November. It's going to mature at 100. They'll get your par back, and your return on that bond will be 0.75. But at this point in time, last year the return was negative. It was 0.73, negative 0.73. It was better than the benchmark, but still negative, which you never like to see. The good in all this is that we're now buying yields of 4 to 5%. We're locking yields of at least 4 to 5%. So fast forward 6 to 9 months from now, a year from now, if we continue to roll over the portfolio at those yields, you're going to be yielding substantial amounts. So I kind of hope that frames everything that happened last year. It was a historic year. It was the worst year in the bond market since the 70s. In terms of our firm, we actually grew assets last year. We're just over 1.7 billion in assets between Bernardi Securities and Bernardi Asset Management. Though portfolios were down, clients are seeing the higher yields, and so our assets actually grew because they're looking to capture these higher yields. In terms of personnel, we're at 26 individuals. We recently hired a new head of credit analysis, Pat Swillia. He came over from PIMCO. PIMCO is one of the bigger bond managers in the country, and he'll be a huge addition to the firm, just broadening our credit scope. In terms of the current standing of the portfolio, even though it was down on paper, it did outperform the benchmark last year. Therefore, the strategy since inception and last year did add value relative to the Treasury alternative. Both portfolios, the water and sewer and general fund, have very short average maturities, just over 1 year. And they are generating some nice yield now. The yield to maturity on the general fund is 3.53%. But as bonds come due, we're now capturing well over 4%, in some cases over 5%. In terms of the outlook, municipal credit is very healthy. A la, kind of what you're experiencing, a lot of cash on the balance sheets. Revenues are still coming in line, growing steadily. And municipal yields offer more yield generally speaking, than Treasury bonds. That said, we're seeing a lot of opportunities in certificates of deposit, backed by the federal government up to $250,000, and U.S. agency securities, Federal Home Loan Bank, Federal Farm Credit Banks. We've added those to the portfolio. You'll see in a little bit that those are new additions to the portfolio from last year. Lastly, just macro-wise, we are in what feels like the late stages of a rate hike cycle. Global central banks are raising rates across the world. Late innings, I don't know if we're at the 7th inning stretch yet, but the bulk of the rate hikes are priced in and have occurred. We're currently at basically a 5% Fed funds rate. Do we go to 5.5, 6? Maybe, but the bulk of what happened last year is the tightening has been priced in. This is all slowing inflation, it's slowing growth, it's slowing GDP and prices, and potentially leading to future lower yields. This chart shows performance last year. Last year, the portfolios were down about anywhere from 0.48 to 0.73%, as I mentioned. The benchmark is down almost 2.5%, so the portfolios were down, but they outperformed the benchmark. Since inception, we've outperformed the benchmark by about 50 basis points as well. In terms of what we own, what kind of assets the portfolios you own, last year it was only taxable municipal bonds and certificates of deposit. This year we've actually added some Treasury bonds and U.S. agency securities. That's that green bar chart. Like I said, we're finding a lot of value in U.S. agency securities. They yield at least 5% today for 2, 3-year agency securities. They're rated AA+ or AAA. These have an implicit guarantee by the U.S. government. You can see here on the next chart, the light green line is where U.S. agencies are currently priced, available to invest at. And they basically, from 2 years on out, they yield 5%. This is from last week. They're now even higher than this.
Matt, give us an example of the difference between treasuries and a U.S. agency security.
There's two main differences. First is the credit. The U.S.
Who are the
Treasury,
issuers of an agency security?
the bonds that you own are the Federal Home Loan Banks
Got it.
and the Federal Farm Credit Bank.
Okay.
These have an implicit guarantee by the U.S. government. They are rated the same as the U.S. government.
Because they're backed by the full faith and credit.
Yeah, it's not a direct, explicit backing, but it's implied. These credits never had any issues in 2008 and 9. So they were tested and they were fine. That's the main difference, the implicit versus the explicit. And then the other difference is the callability. So when you buy a 2-year treasury bond, that bond, if you don't sell it, it's going to mature in 2 years. They can't take it away from you. They can't call it. Agency securities have call risk. So if rates drop substantially, these agencies can call these bonds away from you. That's why they offer so much higher yield, because of that call risk.
They got to pay for that privilege.
Exactly. And so we've added these to the portfolio because we deem the call risk relatively low in this environment. The Fed is still hiking rates. and it's a small portion portfolio. So we've had a little bit of exposure there, just given the attractive yields they offer. And we lost it. Does everybody have a presentation in front of them?
Yeah.
Okay. Sorry about that. So, slide 11,
Title, ladder maturity.
ladder maturity structure. So this is how your, this is how your maturity structure is laid out. You can see, we like to ladder, so you own a certain amount, you own the same amount of bonds, or a certain amount of bonds every year going out to the maximum maturity we can invest. In this case, we can go out 3 years for the portfolio. So a perfectly synchronized ladder is about 1.5 years long. Your average maturity is just over 1.1 years. We find the benefits of this in terms of investing, with just the market. We're not trying to time the market. You always have bonds coming due, so we'll always have the ability to reinvest as the world changes. And on top of that, you always have ongoing cash flows. If you have any capital expenditure needs, we're not going to need to sell bonds. You have on.
And that ladder maturity structure is also a way to syndicate the risk.
Exactly, to diversify
Diversify is the
your yield curve risk across the yield curve as far as we're allowed to go out. Currently, we're allowed to go out maximum 3 years.
That's based on the direction we've given him, when he's saying we're allowed, that's based on direction we've given to Bernardi.
In terms of the market, if you go to slide 13,
title, munis remain high grade.
correct. Default, as I said, municipal credit health is very strong. Defaults are very low. AAA rated municipals have a 0% default rate the last 52 years, and AA rated have a 0.02% default rate the last 50 years. Your portfolio is only invested in AA, AAA rated municipals. It will only ever be invested in those sectors. In terms of the yield curve, I wish I had this screen up. On the next page, Treasury yield curve. It's a very atypical shape right now. This is where your current Treasury bonds yield. So 1 year is about 5%, all the way going out 30 years is 3.6, 3.7%. It's an inverted curve. Short-term yields are higher than long-term yields. This is completely atypical. The reason this is happening is because the Fed is very aggressive on raising that short-term rate. They basically control that. They tell that directly really where it goes. Beyond 3 years, especially beyond 5 to 7 years, the market is controlling that. And so what the market is telling you is that future Fed funds rates, future growth, future inflation is going to be lower than where the current Fed funds rate is now. There's slow growth or recession coming. This inverted yield curve precedes every recession we've had over the last 60 years. So this graph shows the difference between the 2-year and the 10-year Treasury. So right now, the 2-year, and that difference right now is negative 84 basis points, 0.84. So the 2-year yields 84 basis points more than the 10-year. And you can see before every recession this has occurred. Those are those gray bar charts. We haven't been this inverted, this negative. The 2-year has not yielded this much more than the 10-year since the 1980s, which was a crazy inflationary period. We had multiple recessions, very low growth. So the yield curve is signaling oncoming economic weakness. All the alarm bells are going off in terms of the bond market. This is part of the reason why I think also on top of that, you have the Fed reducing their balance sheet. That's causing this. Their balance sheet was lower by about $400 billion this year. You can't really see on the graph here, but it was up to $9 trillion. It's now $8.6 trillion. The money supply is dropping concurrently. We had the first year-over-year contraction in money supply since 1960, since they started tracking this data. So it's the first time it's ever happened. That's down similar to the Fed balance sheet, about $400 billion. So all this is when you typically have these inputs in the system, a decreasing money supply, an aggressive Fed, high short-term rates. What is next When next is, nobody knows, but what is typically next is a rate cutting cycle, lower growth, which is why I think it might make sense to extend the duration of the portfolio a bit. I'm talking very incremental. So right now, we can go out 3 years max. I propose we increase it to a 4-year max, maybe next year, 5-year max, after I come back here next year, and we can discuss. But going to a 4-year max, the average maturity is gonna move from 1.5 to 2, 2-year average. This will lead to potentially higher income in the future, not now. I'm sorry, did you have a question?
Oh, and I want to yield to trustee Schallmoser, because I'm looking at the screen and I'm seeing him. He does a lot of this in his day job.
Oh, great.
And Peter, I'd love for you to jump in at this point to see if you have any comments or questions thus far with Mark's presentation.
Sure. Thank you, President Richardson. The performance is really solid, given.
And let Mark know what you do.
Sure. I'm a senior vice president for Merrill Lynch.
Okay, great.
25 years managing money. So it's this was just a year of all years, right?
Yeah.
Especially for most conservative assets.
Yeah.
On page 8, if you have that handy, the 1 year minus 0.73. We never celebrate a minus ever, but
Yeah.
that is heroic.
Well, thank you.
For what, given the carnage, right?
Yeah.
But I'm interested, the cash, 22%. What is that? Cash return 22.6% for the 1 year?
That's an error. Yeah, that's not right.
Well, whatever that cash is, I want to have some.
Yeah, no, that is an error. I did not notice it. I'm sorry about that.
Okay.
I'll look into that and get back to you on why it was calculating that.
Sure. Divided
Thank you.
in
And that,
2.6, you know, or.
yeah, I don't,
Thank you.
yeah.
So for extending the duration, when do you think is the trigger point? What has to happen with the Fed for you to say now is the time to do that?
I don't know. I don't know the day, the time that happens when they start cutting rates, but by the time they start cutting rates, it's gonna be too late. The first thing they'll communicate is we're gonna stop raising rates. That's at least 6 months out. So it just comes down to that we are late in this cycle. Inflation is coming lower. All the inputs point to a slowing, lower growth. And at that point, it's prudent to lock in some longer bonds. And when I'm talking about longer bonds for this portfolio, it's 4-year bonds. Typically, a recession happens anywhere from 6 months to 2 years when we invert this much. And there's a lot of signals from the economy that are pointing both ways. And unemployment is still very strong, but there's certain manufacturing surveys and growth metrics that are coming in very weak. So I don't have the answer when like that moment will be, but generally speaking, this is a time to extend duration. And the Fed, you can't see it now, but the Fed has said that their long-term projection for the Fed funds rate is 2.5%. So it's very likely in the near future, not too distant future, 2 years from now, they will be around 2 to 3% Fed funds rate. So you'll be happy if you had bought that 4% 4-year bond, 4.5% 4-year bond, instead of staying in a 6-month bond, and that rolls over and you're now faced with a 1%, 1.5%, 2% yield. That's essentially kind of the balance I'm looking for.
Thank you.
Yeah. So that pretty much finishes up the presentation. In terms of extending the max maturity, we would update this on the investor profile, and it would need to be signed off according to your corporate resolution, if you were to agree to that. Nothing else in terms of the portfolio would be changing in terms of the credit allocation, and it's really just an incremental increase in the average maturity.
we tend to go around and let people ask questions, so if you're finished, we can
I'm just gonna throw something there
Please.
real quick, just
come
real
forward
quick.
for the record, because you need to be on camera.
The camera's pointing right to you here, and then I'll
Perfect.
camera to the
That's-
trustees. We are going into budgeting though, and we're just looking to spend a fair amount of money. There might not, I might be need to take money out of the bond market, you know, once those mature, so we might need to, I'll have to take a look at that. Karen and I will sit down and see what we're looking to spend next year, but we are looking to go into a lot of road work next year. That between this forecast of a recession, where we might end up losing LGDF, I mean, who knows, and sales tax. I love the idea of 4 years, but I'm not sure it's, you know, we have the financial wherewithal to do that in the short term.
Yep.
But certainly longer term, we can look at that. But let me turn the camera now to the trustees for your comments.
Well, Matt, first let me offer you an apology. My name is Kevin Richardson, and I get called Richard or
Yeah, it's
Keith
okay.
all the time. I have a friend named Mark DiBernardi in Washington,
Oh.
and I defaulted incorrectly, because I get called Richard and I get called Keith all the
Yeah.
time. And you ought to hear what I get called at home. So my apologies first. The advantage of having been a student of economics as an undergrad is I know enough to ask stupid questions.
Okay. All right.
So on this, you're talking about a controlled extension of our maturity ladder for purposes of mitigating against future economic conditions that appear to be trending. Fair enough?
Correct.
Okay. And this does not strike me as a dramatic change. And we're not obligated to move dramatic amounts of the portfolio that way. It just gives a flexibility for you to take it out one more year.
Exactly. If you extended it to a 4-year max, that doesn't mean we're automatically going to start buying 4-year bonds.
Right.
And a point I failed to make too is the typical shape of the yield curve is the longer you go out, the more you get paid. That's
Right.
not the relationship right now. So, but 90% of the time when we have been investing in this portfolio, up until the last year, the longer bonds we bought, the more yield you get. Hopefully we'll return to that normal environment, and being able to buy that 4-year bond will allow for more income for the village.
Well, forgive me for asking, how old are you?
35.
And I asked, before you were born, 2 wonderful men named Ronald Reagan and Paul Volcker broke the backs of low growth, high inflation with some very painful medicine. And the benefits lasted for 35 years until we started dropping money out of helicopters.
Yeah.
And the problem is now, we owe the rest of the world 31 trillion with a T.
Yeah.
So we don't have the flexibility that our ancestors had when they had to do some of this. And so I'm looking at ways to optimize performance because I see some very dark storm clouds, maybe not in the intermediate term, but in the longer run,
Yeah.
especially for communities and states that are struggling, and Illinois is a struggling state. There are trend lines that are positive.
Yeah.
And so I'm more accommodating in my mind of this because, first of all, the treasurer has my complete confidence, and her husband's in the business that he's in, and you're in a little bit. I trust you guys. But I could get there because I look at macro socioeconomic trends, and it doesn't bring out the Christmas spirit in me. I get awfully anxious about what I think we're going to be facing.
Yeah.
So if you want the flexibility to do this, and we're not mandating it, you don't have a peanut butter spread that 20% is in year 1, 20% is in year 2.
Exactly. Yeah.
It's really a judgment call based on circumstances as things come due and you have to redeploy into new investments.
Yeah.
Right?
Correct.
Okay.
Right now, if we had the ability to go out 4 years, the conversation on the desk today would have been like, should we buy a 6-month treasury bill at 5% or a 4-year agency at 5.25%? That's the debate that
Okay.
in a microcosm
Yeah.
that goes on. I don't know what the decision would be. It's a group decision.
Right.
We have 2 portfolio managers, multiple traders, and myself. And so it's just, like I said, I want to reiterate, in a normal slope and yield curve, you will be adding value, long-term value to the portfolio by being able to buy 4 years versus 3 years.
Okay. Let me yield to my right to Trustee Perkins for any questions she may have.
Thank you very much. Thanks for your presentation.
Yeah.
I have no questions.
Okay, thank you. Trustee Hayes.
Fundamentally, I like what you presented here, and I appreciate, and congratulations for being the rest of the market.
Yeah.
The risk associated with going to 4 years, normally, when you get a higher interest rate, bond prices go down, and when the interest rates drop, they go up. What do you see the risk is in going along in terms of the underlying value of the bond, if we have to pull the bonds to fund something?
Yeah.
What do you see that risk?
Yeah, it's definitely taking a little bit more duration risk. It's incremental versus that 3-year bond you're buying. I could plot it out on Bloomberg for you to actually give you a specific figure. If rates go up by 100 basis points, you're taking this much more percentage risk. I don't know it off the top of my head.
Sure.
But you're essentially, instead of a 3-year max maturity, you have basically 33% of the portfolio maturing every year. So going to 4, you now have 25%. So there's 8% of the portfolio now is now not turning over as frequently. It's really, overall, I think it is insignificant. But if there are major capital expenditures that you foresee the next couple of years, then it wouldn't make sense.
Yeah, we can advise you of that.
Yeah.
So, okay. Thank you very much.
Yeah.
Trustee Schallwasser, I sequenced you last because you know what, you do this in your day job.
You answered my main question, it's great. I know I've been using a lot of institutional money market funds, which
Yep.
we're paying $4.50 now,
Yep.
$4.60, while you're waiting for the Fed to cut. Is that an option?
You currently utilize that, yeah.
What is
The
that?
rate, I think the rate was like around, like you said, 460-ish last time I checked. But those, let's see, it's a Dreyfus, it's managed by Dreyfus, it's a floating rate fund. I believe it's about 4.6%. I'll get back to you on that as well, along with that cash performance. It's a Dreyfus
Is
fund.
it a floating?
It's a floating rate
Or
fund.
is that a money market?
It's a floating rate money market fund.
Okay.
And it also repos, so it'll repo the treasuries. It's purely treasury securities. And they'll repo them, so that adds like 10 basis points of performance. But I can.
So that is an option, if you're using that now?
We always have been in a money market fund
Okay,
since inception. They actually pay something now.
that's great.
Yeah.
Cash has become a viable option now.
Yeah.
One of the only supply into all this mess.
It really has, yeah. And another reason to have a negative outlook on growth is because you have people just parking money in short-term funds and they're not putting into the economy, not investing in it. Bank liquidity is drying up. So we'll see.
You don't solve this mess.
What's that?
You don't solve this mess
Yeah.
without the medicine that the market's about to administer.
Yeah.
The only way you've got to bring the interest rate above the inflation rate.
Yeah. Which I think we're there now on a month-to-month basis. I think inflation's running at 3 to 4% CPI. If you look at month-over-month figures. So we're there.
And it's called demand destruction.
Yeah.
And the purpose of demand destruction is to destroy demand.
Yeah.
Because ultimately it is that fall in demand that puts the pressure on prices to come down and solve this.
Exactly.
I lived through that in my 30s, and Mr. Bateman is about my age and he remembers it.
Yeah.
I think Mrs. Hirsch was about 2, so she wouldn't.
Don't put me in that, yeah.
But the truth of the matter is, you have to stand before folks like us and tell us that the party's over.
Yeah.
I'm glad this job will give you gray hair. So we're grateful. I don't have any further questions other than to express my gratitude for the great service your firm provides us. You've earned our confidence and our trust, and we're grateful for the partnership.
Thank you very much. Thank you for that confidence, and we really appreciate it.
Come on out. It's not bad news, and we'll do something after that.
Yeah. Talk to me like 2 years where we're yielding 4 and 5%.
Okay, I'm just gonna tag along behind him just to do the numbers part. This is gonna be hopefully not trustee death by numbers. But since I'm the granular person, should I try to, do you guys have it, is it easy to see in your packet, or should I try to click?
Tell us what packet number.
It's regular formats, actually, presentation. So it's under trustee, it's under
Treasurer's
treasurer's reports,
report.
investment reports, the first one there.
Okay,
So take a look, if you can see
page
it.
100 in the PDF.
Yeah, I don't have that, yeah. If you can
Right.
see it, just fine, I won't, I mean, I can put my computer up
96.
too. But if you can see it, fine.
Oh, yeah.
Just for later.
Karen's right, page
You
96.
can read it now.
Yeah, page 96.
Thank you.
You've got that,
Yeah,
yeah.
thank you.
Just for later, for fun. So basically, this article I put out actually back in January, it's still somewhat timely. You can go, but thank you for
Okay.
for just missing out. So basically, it talks about our position directly. These states have these loaded cash balances, we're loving it because we're getting lots of interest on those balances. It's kind of a sugar high, because this is not sustainable. So the party, I think, is about to be over. And what I'm doing with the bulk of my corporate investment fund is just showing you the numbers. So like I said, I'm sorry if it's trustee death by numbers, but that's about what it's gonna look like. So are you on the first page that looks like this? Okay, so basically the verbiage here, fortunately Matt covered most of it for me, so I don't really need to go into that. But if you recall, at this point last year, we had this meeting, and it generated a ton of concern. In fact, we had follow-up meetings, follow-up studies, we had experts involved to discuss our issue with our low interest rates, really, and without inflation really outpacing our interest rates, and concern with fund balance. And we had a huge project on that. But just to sort of show you on this page, you can see at this point last year, the general fund, these are just numbers now, had $1.2 million basically in the fund. Water sewer fund had $933,000 in the fund. Flash forward a year later, that fund, general fund now has $2,080,322 in the fund, and we earned $31,000 in interest this year on that fund. Water sewer fund at $1,112,652 in the fund, and earned $23,544. That's great news. And as we talked about, because the interest rates, we were protected, interest rates came down, as you recall, during the year, and then before the Fed kicked them up, rates got lower and lower, but we had these higher earning performing bonds that were still earning, a fairly good return. The problem happened when those bonds retired and we replaced them and bought new bonds. As the Fed increased interest rates, those bonds lost value daily. So that's why we have these large market losses this year. I'm not concerned. I don't intend to sell these bonds. I know if we get in a situation where we have to sell the bonds, we'll have to, have that moment. They are marked in the financial statements. They're marked to value. So we've shown those losses in the financial statements this year. They're not material. For that reason, I'm also not overly concerned. I will tell you, in January, the month alone of January, we had a recovery of $8,000 in the general fund and $4,000 in the water sewer fund. So just in 1 month, they recovered substantially because now, things are going in our favor. So I point that out. At this point last year, at the end of last year, we had $3,867,000 in Barrington Bank and Illinois funds in combination of those different demand accounts. Don't forget we have water sewer money in here and bond money. That's why these numbers seem higher than our quote fund balance. At the end of this year, we had $3,591,000 at the Barrington Bank and Illinois funds, and over the year we earned $48,000 in interest. That's way more money than I make. So compare that to last year where it was just $1,000. So I think this is good news personally for what our bloated balances are generating. These are all everything, as Matt has mentioned, very, very conservative investments. So look at the best return we can on that, but they're conservative by our design and by our investment policy. That's the ranking of how things are invested. Everything is invested in compliance with our investment policy. So then if you go to the next page, which I apologize, I don't know your numbers in the packet. Would it be 99, Karen?
97.
97, excuse me. So these are basically, once again, just numbers. And so this general fund, will show you from inception. Back in 2015, we put $700,000 in the fund. And then each year you can see we've earned interest and we've lost market value or gained market value as the year progressed, all the way down to the end where it's worth $2,091,000. So interesting, since inception though, these bonds are up 1.17%, and that's taking into account all the losses in the fair market value. So overall, I'm very pleased with it. Next page, which apparently must be 98, is just the general fund again, and this is what I just do on a monthly basis to kind of watch the flow within this account between the cash account and the fixed income account, and you can see at the end of the year, all the way over far right with the totals, you can see we did earn the $31,000 in interest this year, and you'll see that I marked the $56,000 loss in the value. But you can also see, we don't have this here, but at the end of January, there's only $1,000 in the cash account. So there isn't any cash to invest currently. So the next time we can actually change the ladder to 4 years would be when some of these investments mature. And we'll have to see what our cash needs are going to be going forward. So then just to go to the next page, I've done the same thing for the water sewer fund. Just once again, it's the numbers, the granular detail. We started with $500,000, over the years, and now that fund now is $1,118,000. And this is not all just earned over the years. We have put money into these funds as we've increased increased fund balances. That's where the money's gone. Next page is once again just the month-by-month view for 2022 of the water sewer account to show you the activity throughout the year in that account. As I mentioned before, we had $23,544 of interest in the year, and the fund did lose, and I can't even see this number, it's so small, I think it's $39,000 over the course of the year. Now, if we were an institution where our liabilities were being tagged to our return on these investments, I would be concerned if we were a big pension fund of sorts, but we're not. So I don't think we have it. It's something to think about in case we do need to liquidate quickly. We'll have to recognize these losses, but at this point, I'm not concerned. And the very last page, and once again, I'm required to show you all these numbers once a year. So here you have it. The column on this is the cash balances in the Barrington Bank or Illinois funds, and this is just the cash we have. Now the good news is at this point last year, Barrington with the bank was paying 6 basis points. It was 0.066%, which is basically 6 cents on $100 invested for a year. Now I just checked today, it's 4.41. So we're getting $4.41 versus 6 cents over the year. I mean, you couldn't even predicted this. It's astronomical change. So I think that's really good news. And Barrington Bank and Illinois funds, I track them almost daily, and they're really competitive. In Illinois funds, I believe that Barrington Bank is tagging with Illinois funds because I gave them a hard time years ago. I said, I'd rather keep my money in Illinois funds. They're paying me a much better rate of return. And next thing you know, they're matching the return. So I don't know what I said made a difference, but it certainly made me happy. So that's pretty much a granular look at the numbers. I know I went through it kind of fast, but I didn't want to be totally asleep. But are there any questions? Happy to answer any questions anyone has or come back to you with answers as needed. Okay.
Peter, Susie, Rich? Okay. Thank you.
Okay. You're welcome.
This will shorten the rest of the meeting because we'll get into the other things. I don't have anything else in the President's remarks for tonight, so we can move. Agenda item 6, this is the first opportunity of the agenda for the public to address the board. No member of the public is in attendance, so we can move to the consent agenda number 7. A, 2023 road program engineering design. B, employment agreement and compensation of village administrator. C, ground mounted solar panels, renewable